Did you know that 90% of active investors fail to beat the market over the long run? And yet, Warren Buffett has consistently outperformed the market for decades. How does he do it? It's not magic, it's strategy. Buffett's method has turned him into one of the wealthiest people in the world, with a net worth of over $100 billion. But even he wasn't immune to mistakes. In this video, we'll break down 6 common mistakes that every investor makes, mistakes Buffett himself warns against. From chasing hot stocks to letting emotions take over, these errors cost investors billions every year. But don't worry. By the end of this video, you'll know exactly how to avoid them and build wealth the Buffett way. So, if you're ready to learn from the best and stop making these costly mistakes, keep watching. Chapter 1. The shiny object trap. Chasing hot stocks. If there's one thing Warren Buffett's taught us, it's the importance of sticking to your plan and ignoring the noise. Many investors get caught up in the hype of hot stocks. One minute it's tech, the next it's a new biotech or electric vehicle company. We all know what happens when you chase the latest trend. You often end up buying high and selling low. Buffett calls this speculation, not investing. He often says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This advice is a reminder that successful investing is about long-term value, not short-term excitement. Think about it, investors in the dot-com bubble thought they could ride the wave, but those who didn't stick to strong, consistent companies saw their portfolios evaporate. Buffett's strategy is simple. Find a business with a durable competitive advantage and a proven track record, then hold it for years, maybe decades. The real money isn't in trading or following trends, it's in investing in companies that grow slowly, steadily, and surely. In 2020, when everyone was rushing into hot stocks like Zoom and Tesla, Buffett stuck to his guns, focusing on the fundamentals. It's not just about buying stocks. Buffett's approach focuses on the quality of the business behind the stock. Does it have a strong management team? Is it in an industry with staying power? These are the questions that matter, not what's trending today. Stick with companies that have proven to weather the storm, and let time do its work. Chapter 2. Fear and Greed. The unseen forces behind poor choices. Buffett has said, the stock market is a device for transferring money from the impatient to the patient. Fear and greed often drive short-term thinking. When markets are high, greed takes over, pushing investors to make risky bets on stocks they don't understand. When markets dip, fear takes over, making people sell out at the wrong time. The key to avoiding these mistakes is patience. In the 2008 financial crisis, many investors sold off their portfolios in panic, but Buffett stayed calm. He famously invested $5 billion in Goldman Sachs during the crisis. The stock market had dropped, but Buffett knew it was a buying opportunity. It's easy to get swept up in the frenzy of a bull market or panic in a bear market. But Buffett's rule is simple: don't let emotions guide your decisions. Be fearful when others are greedy, and greedy when others are fearful, he says. When fear grips the market, that's often when stocks are undervalued. Buffett has made many of his most profitable investments during times of market turmoil. When the public is running for the exits, that's when the patient investor can step in and scoop up bargains. Remember, investing isn't about timing the market, but about understanding it. Investors who let fear or greed make their decisions rarely succeed in the long term. It's about sticking to your strategy, regardless of market conditions. Chapter 3. The get rich quick fantasy. Buffett's slow and steady wins. Everyone wants to get rich quick, but Buffett knows better. His success didn't come from gambling on high-risk stocks or jumping in and out of the market. It came from decades of disciplined investing in strong companies that grew over time. The get rich quick mentality is dangerous. Most investors who chase quick profits end up with nothing but losses. Buffett has always believed in slow, steady growth. His strategy revolves around finding companies that will increase their earnings year after year, rather than trying to time the market for a short-term windfall. Buffett's long-term approach has paid off, big time. For example, his investment in Coca-Cola in the late 1980s has turned into one of the most profitable moves of his career. He bought the stock at around $3.25 per share, and it's now worth over $50 per share, not to mention the dividends he's collected along the way. Buffett often talks about how compounding is the eighth wonder of the world. He says, "He who understands it, earns it, he who doesn't, pays it." This is key to his success. By investing in quality companies and allowing time to work its magic, the returns grow exponentially. You don't need to bet the farm on the next big stock. Instead, focus on companies that have a sustainable business model and strong management. The stock market isn't a place to gamble, it's a place to invest in businesses that will grow over time. In fact, studies show that holding investments for the long term leads to better returns. The average investor, on the other hand, tends to buy and sell at the wrong times. A report from Dalbar, a financial research firm, shows that over a 20-year period, the average investor earned just 2.6% annually, compared to the S&P 500's 8.2% return. Buffett's success shows that slow and steady wins the race. He doesn't try to get rich overnight. He's built wealth by investing in high-quality companies and letting his investments compound over time. It's not glamorous, but it works. If you're enjoying this content, don't forget to hit that subscribe button and stay tuned for the next chapters on Buffett's investing strategies. Chapter 4. Overconfidence. When knowledge becomes a hindrance, we've all been there, feeling like we know exactly what the market is going to do next. Overconfidence can lead investors to take unnecessary risks, thinking they can beat the market with their knowledge. But as Warren Buffett often says, the more you learn, the more you realize how much you don't know. Buffett is one of the most knowledgeable investors in the world, yet he constantly emphasizes the importance of humility. He's never overconfident in his own abilities and always admits that he's wrong when the situation calls for it. In fact, he spends hours every day reading and learning, knowing that no one can predict the future with certainty. Many investors, however, ignore the power of uncertainty and instead place risky bets based on gut feelings or short-term insights. This overconfidence often leads them to believe they can time the market or pick winning stocks consistently. But even Buffett makes mistakes. He's publicly admitted that not every investment he's made has been a winner. For example, his investment in Dexter Shoe Company in the 1990s was a loss he called one of his biggest mistakes. Buffett's approach is to invest within his circle of competence, the areas where he has the most knowledge and experience. He says, invest in what you know. By focusing on companies or industries you truly understand, you reduce the chances of overestimating your abilities. One of the key lessons from Buffett's strategy is that overconfidence leads to rash decisions and big losses. By sticking to what you know, accepting that you won't always be right, and learning from your mistakes, you can avoid the pitfalls of overconfidence. It's not about being perfect, it's about being consistent and realistic with your approach. Chapter 5. The penny wise, pound foolish mistake. Ignoring quality for cheapness. When it comes to investing, finding a bargain isn't always the best strategy. Buffett's famous for his mantra, price is what you pay, value is what you get. Too many investors focus on buying cheap stocks without considering the quality of the underlying business. While it might be tempting to buy a stock at a low price, it's the value of the company that really matters in the long run. Buffett's approach is all about finding businesses that are both high quality and fairly priced. He doesn't look for cheap companies. Instead, he searches for businesses that have a strong competitive advantage and will continue to grow over time. Take his investment in American Express, for example. In the 1960s, the company was struggling, and its stock price had fallen. But Buffett saw the long-term value in the brand and the customer loyalty it had built, so he invested heavily. That decision has paid off tremendously over the years. Buffett often talks about investing in companies with a moat, a unique competitive advantage that protects them from competitors. Whether it's brand recognition, cost advantages, or network effects, the companies that succeed over time have these advantages. By focusing on quality businesses, you ensure that your investments will stand the test of time. Ignoring quality in favor of cheapness can lead to disappointing results. Take the example of companies with declining earnings or high debt. Even if their stock prices seem low, these businesses are often risky investments that could fail to recover. Buffett warns against buying low-quality stocks just because they appear to be a deal. A good example of the penny wise, pound foolish mistake is investors who buy stocks simply because they are undervalued, without taking into account whether the company's fundamentals are strong enough to sustain growth in the future. This is why Buffett stresses the importance of looking at the business itself, not just its price. Chapter 6. The herd mentality. Why following the crowd leads to disaster. It's easy to get swept up in the excitement of everyone around you. When the market is going up, or when a hot new stock is gaining attention, it feels tempting to jump in. But this is one of the biggest mistakes you can make as an investor. Buffett is known for his contrarian approach, which is basically the opposite of following the herd. As he puts it, be fearful when others are greedy, and greedy when others are fearful. This advice highlights the importance of resisting the pressure to follow the crowd. Investors who follow the herd are often buying high when everyone is excited, only to sell low when panic sets in. Buffett is famous for going against the grain. He made billions by investing in companies when the market was pessimistic, like during the 2008 financial crisis. While many people were selling out of fear, Buffett saw an opportunity to buy quality stocks at a discount. His investment in Goldman Sachs and General Electric during the crisis is just one example of how going against the crowd can lead to great returns. The herd mentality leads to market bubbles. Think about the dot-com bubble of the late 1990s. Everyone rushed to invest in tech companies, even if they had no earnings or solid business models. When the bubble burst, many of those investors suffered massive losses. Buffett saw the bubble coming and stayed away from those overhyped stocks. Investors who follow the crowd also tend to panic during downturns. During market crashes, it's natural to feel anxious, but selling just because others are doing it will almost always lead to regret. In fact, research shows that the best time to buy stocks is when others are most fearful. According to a study by Dalbar, the average investor has earned significantly lower returns than the market due to emotional decision-making. Buffett's strategy is simple: stick to your plan, focus on value, and ignore the crowd. In the long run, patience and rational thinking always win. It's not about jumping on the latest trend, it's about choosing the right companies to invest in and holding onto them for the long term.